Hi guys, welcome to Practical Trader. I hope now everyone is familiar to a bear and bull market as introduced in our previous video. If you want to keep your returns from the portfolio in the bright side in a bear market, here are 3 takeaways. 1. Selling out. One of the safest strategies and the most extreme is to sell all your investment and either hold cash or invest the proceeds into much more stable financial instruments such as short-term government bonds. By doing this, an investor can reduce their exposure to the stock market and minimize the effects of a raging bear. That said, most, if not all investors, have no ability to time the market with accuracy. Selling everything, also known as capitulation, can cause an investor to miss the rebound and lose out on the upside. For those who want to profit from a falling market, short positions can be taken in several ways, including short selling, buying speculative put options, all of which will increase in value as the market declines. Note that each of these short strategies also come with their own set of unique risks and limitations. Two, playing defense. For investors looking to maintain positions in stock market, a defensive strategy is usually taken. This type of strategy involves investing in larger companies with strong balance sheets and a long operational history. Stable, large-cap companies tend to be less affected by an overall downturn in the economy or stock market, making their share prices less susceptible to a larger fall. These so-called defensive stocks also include companies that service the needs of businesses and consumers, such as food purveyors or producers of other staples. With strong financial positions, including a large cash position to meet ongoing operational expenses, these companies are more likely to survive downturns. On the other hand, it is riskier companies such as small growth companies that are typically avoided because they are less likely to have a financial security that is required to survive downturns. Three, shopping for bargains. A bear market can be an opportunity to buy more stocks at cheaper prices. The best way to invest can be a strategy called price cost averaging. Here, you invest a small fixed amount, say 10,000 rupees, in the stock market every month, regardless of how bleak the headlines are. Invest in stocks that have value and also pay dividends. Diversifying your portfolio to include alternative investments whose performance is non-correlated with stock and bond markets is valuable. For instance, when stocks crash, bonds and commodities tend to rise as investors seek safer assets. These are just 3 of the more common strategies tailored to a bear market. The most important thing to understand that a bear market can be a very difficult one for long investors because most stocks fall over the period of a bear market, and most strategies can only limit the amount of downside exposure, not eliminate it. Thank you and happy investing.